Okay, then, so we'll look at, go back to the, so chapter 17, we'll look at now investment classifications. Okay, so far we've done preferred shares, equity, common shares, conversions, dilution, treasury stock, all from really the issuer's point of view, the company, what their equity section looks like. Now we're switching to investments, right? What does all these things mean for the investor? Okay, so they're buying debt, they're buying equity. How do they record those in their books? So it's all from the investor's point of view now. We're going to switch from issuer to investor. The key part of this chapter, I would say, it's all here. About 90% of it is here in this chapter. Okay, it's kind of daunting, but it's not really. It looks daunting, but it's not. It's a big spreadsheet. So the investor can buy debt or equity. We know that. Okay, right. So now we're going to split the investments into three: trading, AFS or ABS, and held to maturity and equity method. There are six classifications. These two are the same: trading, AFS. So the investor can buy a bond. It can be a trading bond. That means they'll sell the bond anytime. If the price is good, they sell. Okay, so that's short term. Trading is short term. AFS is medium term. They'll keep the bond for 3 years, 5 years, and then sell it. It's a short term investment. Held to maturity is they'll keep the bond until it matures. So we have three choices. Okay? Equity, same thing. They can buy shares and they're trading shares. And they can buy and sell all the time, every day. Or they can buy shares in a company, AFS, medium term, for some other reason. Perhaps they want to get ownership on the board or some influence or something. They're not there for a quick profit. They bought these shares on purpose, perhaps to control the company later on. Okay? And then equity method is the long-term influence. That's kind of separate, and we'll do that later. But basically, you now have, when you buy an investment, you have three choices here and three choices here. And each one determines the accounting. The accounting is different for each. Okay? So basically, if you buy a bond, you classify it as short term. You are going to do a fair value adjustment every month. Right? Because the bond has a carrying value. Whatever the carrying value is. If the market price is higher, you book a fair value adjustment. Okay? And the fair value adjustment goes to the income statement. So if the bond is worth more, you would debit the bond and credit unrealized gain on income statement. Okay? If you buy a bond that's AFS, medium term, you'll do a fair value adjustment. But the entry is in the equity section. So if the bond goes up in value, you debit the bond, or fair value adjustment, and credit unrealized gain, but it's in the equity section. Yes.
It wouldn't be in the asset section if you're...
Well, the other side's asset.
Oh.
The credit is not income statement, it's in the equity section. Just for this one category.
Oh, other comprehensive income category?
Yes, like that.
Oh.
Okay. So again, if you have a trading bond, you have a value, a book value, wherever it is, do a fair value adjustment. If the bond goes up, it's worth more, you debit, fair value adjustment, and credit, unrealized gain, income statement. Medium term bond, exact same, except the credit is an equity or loss. No income statement impact. Held to maturity, fair value, you don't care. Because we'll hold it to the end. Right? This is kind of an overview of the chapter. Okay, equity investments. You buy shares in the company. Trading or short term or medium term, it's the same entry. The unrealized gain loss is an income statement. Okay? So only the bond is the odd one, equity. These two are, in fact, the same entry. The fair value adjustment and the gain loss is an income statement. And equity is different altogether, and we'll do that later. Okay? So, this is kind of overview of the chapter. Equity. Okay, also, the equity method, you must use equity method if you're between 20 and 50% of the stock of the company. Okay, below 20, you're one of these two. 20 to 50, you're here. Okay? So not only is it what type of investment is it, but how many shares do you have? Less than 20, you're in this bucket. 20 to 50, you're here. We'll do this in detail in the chapter overview. Okay. So, less than 20, these numbers are not hard rules. Right? It's all about influence. If you have no influence, we assume you're here. If you have some influence, you're here. Okay? And these are the guidelines. 20%, below 20, above 20. Okay? Above 50, you consolidate. But that's not in this chapter. Okay? So we're going to go through the examples of this. And it's clearer in the text. But this is a useful thing. This is where we're going with this. Okay? We're going to look at all six methods. Okay? But they're all very, very similar, really. It's just the unrealized gain loss is in different places. Well, two places. Equity section or income statement. Okay? So keep referring to this as we go through the chapter. It's quite useful. It's only 11. All right, so there is some repetition early on. Okay, so we'll look at debt, we'll look at equity, and then equity method. Okay? So first we'll look at the three debt classifications. All right. Again, kind of repetitious. Okay, so here's my kind of the text solution, slide. Debt, equity, two choices. Plan to sell or don't plan to sell. Okay, debt, we're not going to sell. That's held to maturity. It's only amortized cost. Debt, if we're going to sell it, we must do a fair value adjustment. Okay, which is just the top two. Okay. Equity, if we plan to sell it, fair value, which is the top two again. Top two. If we're not going to sell it, but we bought the shares for another reason, perhaps takeover or something like that, a long-term strategy, then we use equity method. Okay? So that's the top two, that's the bottom line. So again, this is kind of repetitious of chapter 14, bonds. It's not the important part of the chapter, we've already covered bonds. But you can buy different types of bonds. There's your three choices. This is basically my slide, my spreadsheet, kind of summarized. But I think my spreadsheet's better. So I would ignore this, use my spreadsheet. Okay. Okay. So this goes through now buying a bond, which we've done before. You buy a bond, you amortize the discount and the premium, we know all that. Effective method, we know that. But the important thing is, if you go back to the classification, when an investor buys a bond, they must decide on these three. What are they? At the outset, on their books, which one is it? They must decide straight away. And what they're saying here, basically, if you want to hold a bond to the end, you must have the intent to hold it, and you must have the ability to hold it. So what does that mean, do you think? If you want to classify a bond as held to maturity, the intent and the ability. So what does it mean to you?
Pay interest?
Huh?
Be able to pay interest on it?
No, we're the investor. There's all investments. We're the investors now. What does this mean? The intent, I want to hold it. What the second one?
It means your cash flow is enough to support not needing that money until it matures.
Exactly. If I bought a $10 million bond, I'm saying I can do without the 10 million until the bond comes back, until it matures. So I want to hold the bond forever until it matures, and I can, because I have enough cash from other parts of the business. So there must be two reasons: the intent and the ability to hold it, to do without the cash until the bond matures and you get the money back. Okay? So that's a key thing. Two reasons. And so here's a kind of repetitious. We buy a bond. Now it's the investment point of view. We bought a bond and it's at a discount, $92,000. And we gave $100,000 to the issuer. No, the payable's 100, sorry. We bought it for 92. The investor does not record discount or premium. It's one account, 92. Okay, the issuer does the premium discount. Or yeah. Investor, no, it's one account. Debit investment, credit cash. Okay? And then the investor has the same table as the issuer. The exact same table. The investor is now receiving $4,000 every 6 months. Cash received. The revenue is the market rate times carrying value. There's the revenue. And then we effectively amortize the discount and we add that to the bond because we are going to receive $100,000 when the bond matures. It's the exact same schedule. Okay? But it's reversed. We now have revenue, not expense, cash received, not paid, and this $100,000 is due to us, not to be paid. Complete opposite. Okay? But it's kind of very, very similar. Chapter 14. Okay? So that's it. The investor, every 6 months, gets $4,000 cash. There it is, cash for revenue is $46.14. And the difference we add to the investment, $6.14. Because the investment will now rise to face value. Because that's what we're receiving at the end. Okay? So keep doing that. The next one, exact same entry. Receiving $4,000 cash, revenue $46.45. And then we increase the investment by $6.45. That adds to carrying value, $200. Okay? So exact opposite of issuer. The big difference is we only book one line for the investment. There's no discount premium. It's just one line. Okay, so there's the perhaps the balance sheet year end. This 4,000, we've earned it in 16, but we're getting paid in 17. So we accrue the revenue. Okay, we have earned 8,000 in a year. The payment's on Jan 1, remember? So the issuer accrues the expense, investing accrues the revenue. So we accrue the revenue, so we have a receivable of 4,000 at the year end. Our investment is worth 93 at year end. And our revenue for the year is these two, 9249. Okay, so this is the investor's table. Investor's point of view. So what if the investor sells the bond? The investor sells the bond on November 1, 2020 for 99.75 plus interest. Okay. So let's look at the entry. So here's the this is the year-end entry here. 4,495,952. So we have to, when we sell a bond, remember we did this, we need to work out the carrying value. What is the carrying value of the bond on the day we sell it? So we need the carrying value on November 1, 2020. We know it's 99 on July 1, and it's 100 on Jan 1. So in between these two numbers, is the carrying value on November 1. So we just take, this is the 6-month entry, 952, and we'll take 4/6 of it. That's July, August, September, October. So we'll take 4/6 of that, which is 635, and add it to our investment. There's the revenue, 635. So our carrying value is actually, when we sell the bond, is the 99 on July 1, plus that extra 635. Our carrying value is 99,683 on day of sale. Okay, and we got 99.375 for it. So that's 99,750. On our books, it's worth 99,683. So we've lost 67 on the day. 67. Okay. So it's always selling price less carrying value, and you have to adjust what you have to get to the right figure. On November 1, it's 99,683, not 99,048.
How do you calculate 99,750?
Sorry?
Selling price?
Yeah, we sold it for 99.375 of face value, which is 99,750. Right, remember this is the carrying value on July 1. That's no good. This is carrying value on December 31. That's no good either. It's somewhere in between you want to have this money. And it's 4/6 of this. This is the 6-month entry, we want 4 months of that. 635, and we make a gain of 67. There it is, 67. Okay. We sell the bond on November 1. How much interest are we owed up to that point? We're owed 4 months interest, because the last payment was on July 1. So we're owed 4 months interest, and the buyer pays us. The buyer pays us, they receive 6 months interest from the issuer. Okay, so we also get the 99,750 plus 2,667 this revenue as part of the price. So there's 99,750 plus 26 is that. There's the revenue we book. We clear off the books, and there's the gain. Okay. This is the total cash we get. It's the accrued revenue plus this. Remember, the issuer, the seller receives the interest from the buyer they have not received from the issuer yet. Does that make sense? No. I'm the investor. I'm owed 4 months interest. You're buying the bond. The issuer will give you 6 months, but you have to give me 4 months. Net 2. Okay. Right. This is kind of irrelevant to this chapter, but it's got recapping bond. Okay. All right. So that's the first one. AFS. So that's held to maturity. Okay. There's no fair value adjustment. Okay. AFS. We're going to sell the bond in 3 to 5 years. Okay. We must do a fair value adjustment, and the unrealized holding gain is in the equity section. Okay. So let's look at that. Here's the bond, again, the premium, 108, there's the investment. We credit cash 108. A new table is formed. There's the payments we receive, 5,000. Pretty straightforward. Again, receive 5,000. There's the bond. Well, we'll lower the carrying value to 100. There's the revenue, market price out the carrying value. Get the 5,000 cash here. So revenue for 17 is that. So 8621. All right. Okay. So here's the deal. Fair value adjustment. Now we're going to do the middle one. The middle one on bond. AFS, equity section. So we're told at year end in 16, the bond is only worth 105. That's the fair value. Only 105. The carrying value year end is 106,732. We must do a fair value adjustment. So we do, it's called fair value adjustment. It's contra asset. and we do negative 7032. And here's the unrealized, it's a loss, equity section of 1732. So now our carrying value is actually 105, which is the fair value of the bond as of year end. Okay? This is contra asset. Okay, or it's contra asset. If we have a gain, it increases the asset. If we lose, it reduces the asset. So this is in the asset section of the balance sheet. It's like depreciation, it's like AR allowance. It's just a contra asset account. So if we lose 7032, contra asset, and that's in the equity section. And that's it. That's what you do. Okay. Okay, so here's an example of a portfolio. This company has 2 bonds, right? There's the cost, fair value. And they, what is it? Oh, and they classify AFS. They're telling you it's AFS, bond. So it's the middle one, right? It's the middle one. You must do a fair value adjustment, and the unrealized gain loss is in the equity section. So here's our table. Cost 293. That's carrying value. Fair value 284 is at year end. 284. We've lost 95,000 on the deal. 95. So we have to do a fair value adjustment of 95 to get this down to fair value. And we do it. There it is. Same entry again. Credit fair value adjustment, contra asset, and debit equity section, unrealized gain loss. 9537. Okay, that makes sense? Now this portfolio on the books is worth 284. That's on the balance sheet, 293. And that's on the balance sheet, contra this, to bring it to 284. Make sense?
So this is given, everything?
Huh?
The whole table is given in the question?
Yeah.
Oh.
You have to. You're given the fair values,
Mhm.
and you're given the cost, carrying value. Just make the fair value adjustment entry. Okay? So debit equity, 95. Credit fair value adjustment, 95. Okay. So I think what happens here, they sell, this is 17, okay? So 18 comes along, and the company sells Watson. We had 2 bonds at year end. Sorry, lost track of this. We had 2 bonds at year end. The following year we sell this one, Watson. We sell it. Okay, so here it is. We sell Watson for 90. Fine. And at the time it was worth 94,214. You're told that, right? It was worth 94,214. So we've lost 4,200. We book it. We got the cash, 90. We clear the investment, 94,214, carrying value. And we have 4,214 realized loss, income statement. Realized losses, income statement, or gains.
Would you record the accompanying, the fair value adjustment?
Hang on, I'll get to that.
Sorry.
Let's get to that. Okay. So this bond's gone. We got the cash, off the books, carrying value, lost 42, realized loss, income statement. That's 18, July 18. So, and now year end comes along. It's year end again. We still have Anacom on the books. And the cost now, the carrying value right now is 200. Right, it'll change. It'll keep changing every period as we amortize the bond. As of year end, the carrying value was 200. And now it's worth 195. So we have to, the unrealized loss is 5,000. Okay. But here's the tricky part. We've got 95 credit in there from last year. Right? We have to adjust the fair value account. We want to see 5,000 negative as of year end. From last year, we have 95 negative. So we debit the account 4537 to get to -5. This is not the entry we make. We have to adjust what we had before. Remember the 95, this 95 carries forward. These are both balance sheet entries. They carry forward. So now you want to see -5, so we will debit the account 4537. We have an unrealized gain, equity section, 4537. With this entry, we will have -5 here. Okay, so you're adjusting it. This is not the entry. That was prior year. You have to adjust this to get to this. That's plus 4537. So we have gained by 45, right? Our portfolio was down 95. Now it's down 5. So we've gained 45 in the year. Unrealized gain, equity section, 4537. Okay.
So basically, you do all the fair value adjustments according to the portfolio, not individually by the companies? Or for
Yes,
the purpose of this?
Typically, yes. You're not going to have accounts for every investment.
Okay.
But you would have a subledger
Yeah,
of all the detail.
right.
You just book this. You guys understand this? So the key point, this is not the entry, this is the ending point. We're starting here, ending here. That's just what we need to get to here, based on that from last year. Okay? That's pretty much it for the AFS. So there's the balance sheet. Fair value is 195. That's not quite true. We have a 200,000 debit and a 5 credit that makes the 195. Right? We have this 200, and the fair value adjustment is now 5, a -5, which makes the 195. We have a 5,000 loss equity section, and we have lost 42 in the year on that sale. Okay? So that's balance sheet, equity, income statement. All right. A trading bond, exact same entry, except it's the income statement. Exact same entry, except income statement. So here we have a bond, a bunch of bonds, and we're told it's trading. We're told it's trading. So it's the first line we're doing. It's the first line. Do a fair value adjustment, and increase, decrease goes to income statement. Okay, here it is. It's a portfolio, 314. It's worth now 318. Good. We've gained by 37. Let's book it. There it is. Fair value adjustment. Increase 37. And we have an unrealized gain. And this means income statement. Right? It's not equity. Income statement. Okay. That's it. Really, basically. So we do that entry. Again, it's contra asset. And typically they always sell one of these in the year. This is what happens. They say, here's our portfolio, here's what it is, do the fair value adjustment, the portfolio changes, and do the adjustment again. That's the nature of these things. So here's an example. This company bought a bond, 50,000 at par, it pays 2,000 interest every year, and the fair value year end was 47.4, and it's trading. It's a trading bond. So it's the first category. So record the purchase, record the interest, fair value adjustment. Typical question, very typical. So record the bond, we bought it at par, there's the 50, there's the investment, cash 50, interest of 2, book that, cash, revenue 2, pretty straightforward. And then it's worth 47.4, at year end. So do a fair value adjustment. Credit of 226. Your unrealized loss, income statement, 26.
Okay, that's what we used to.
Does that make sense? Any questions? This chapter really is about the fair value adjustment. That's all it's about, really, the fair value adjustment. Okay? Okay. Okay. So, let's look at these three categories. So you buy a bond, you're a big company, JP Morgan or Chase. You buy a bunch of bonds, big bonds, billions of dollars. Which of these do you pick? This is the problem. People pick these categories based on expected prices, not on the intent. Okay? Let's put it this way. If you expect bond prices to fall, which is the best category to pick?
Probably medium, well, probably short term, probably. Well, probably medium term, because short term, you can sell at any time.
No, but, okay. Okay. Anybody else?
Short term, because then you can write it off as a loss.
Okay.
Do you maturity because you're expecting it to go up in the future, or?
No, we expect it to fall. Assume bond prices are
Wait.
falling. We expect bond prices to fall for the next 5 years. And you'd support a bunch of bonds.
Yeah, you
Which
probably.
is the best category for your income statement?
Oh. Probably hold till maturity.
Why?
Because you wouldn't have to worry about recording the loss.
Exactly. So a lot of companies, even though this is the rule, short term, medium term, how maturity, it's based on intent. But a lot of banks will say, you know what, God, bond prices are falling. Oh, all my bonds are this. So there's no fair value adjustment every month. So the losses are off the income statement. Sorry. Well, in this case, the loss will be off the income statement. In this case, the loss will be not in the equity section. So you want to pick held to maturity if you expect bond prices to fall. Your income statement is insulated. If you expect bond prices to rise, which is the best one to be in?
Short.
Short, because it's income statement. Woo, been a great year. So the unrealized gain loss will be income statement, which is great. We look good this year. Bond prices are rising. So this slide, the next slide, that's what they're talking about. That people pick categories based on expected prices. Was not the intent of the categories. It's based on intent. Okay? So what is the problem if bond prices are falling, and you pick this? Eventually they'll catch up with you, right? Because you've got to sell the bond. You've got to clear the bond eventually. You'll take a big hit. Eventually. Because they're not going to hold to maturity. They're just a category of in. They will sell the bond at some point. And what if they have to sell the bond? What if they need the cash? If they're bankrupt or in cash flow problems? What if they have to sell the bonds? They'll take a big hit on the
In
day they
1
sell the
year,
bonds.
yeah.
So rather than spreading out the loss gradually based on market prices, if they're in this category and are forced to sell for some other reason, that's a big hit to the income statement in one fell swoop. So it's a game they play, and the slide I think kind of talks about that. It talks about that. You can see in this example, they moved 293 billion to held to maturity category because they expected bond prices to fall. Okay, so it shouldn't be like this. It should not be, but that's what banks do. Okay. Yeah. So again, here's the second example. If a bond has problems, liquidity, needs cash, They got to sell their investments, sell their bonds. They'll take a big loss. And that might lead to a crisis if some banks are collapsing. Okay. So it's a risky game. So that's it for the bonds. Do you guys get the bonds? It's very, an equity is very similar. It's very, very similar. Okay. So here's the investment. Okay, so let's go back. Okay, so when you buy shares, the cost of your investment is the security plus the commissions and fees you pay. It's not a separate account. You don't expense the fees and commissions. It's part of the investment. Okay? So if I buy shares for $1,000 and it costs me $100 in commissions, the investment on my books is $1,100. It's not $1,000 and expense $1,100. The investment is $1,100. Okay, so always combine the costs and the shares together into one number. Okay. Okay. So here's my slide basically. My spreadsheet. Different way. The cutoff is 20%. The cutoff is 20. Below 20, you use trading or FS. They're both the same. Same accounting. 20 to 50, use equity method. We'll do that. Above 50, we consolidate. That's not in this course. Okay. But again, I keep stressing the point. It's about influence. It's about influence. Okay. So let's say I've got 40% of Apple. I own 40% of Apple. Do I have influence?
Controlling interest.
Not controlling. I have some interest. I have some influence. I own 40%. When can you own 40% and have no influence?
Someone else owns 41 or 50 up.
Keep
Someone
going.
else
Keep
owns
going.
a significant amount.
Keep going. 60. If I own 40% of Apple and another person owns 60, I have no control. I have no control. No influence. So that means I'm in this category. This is no influence. So these are guidelines. 20 to 50 is a guideline. I can have 40% and be in this category because I have no influence. If the other person's got 60%, my 40 is useless. Right? So it's only a guideline. Can I have 18% and have influence?
Yeah.
Is that possible? Why?
If other person says less.
How many? If other people have less?
Yes.
How many people?
If you had 8 other people with 10% and then one with 2%, then you would have the biggest.
But they could all gang up against you.
Ah,
If 5 have 10 and you've got 18,
yeah.
those 5 vote together, that's 50 right there. So when can you have influence with 18%? We're almost there. It's just numbers. Okay, what if I have 18 and then somebody else has half, 1, 0.2, 1, 0.1, half, 2, and they never vote.
And
They never show up.
yeah, if they all together are less than 18, then you have.
No, they're 72 altogether. No, 82. Altogether 82, but they never vote. They're kind of small, sporadic. 1 here, half, 0.2, 0.3. My 18's a big number. And they never vote together. They're kind of all over the place. So my 18's pretty good. So I have influence. So then you must pick this method. Right? It's about influence. This is no influence, influence. 20% is the guideline. If no one talks about influence, below 20 is this, above 20 is this. But if you mention influence, you have to have influence to be here, no influence here. Okay? So it's about influence really. But if no one mentions influence, you go by percentages. Okay? So it's just a guideline. My spreadsheet. My spreadsheet, here it is. Less than 20, we assume you have no influence. Below 20. That may not be true. it may not be true. 20 to 50, we assume you have influence. But again, it may not be true. Its influence is the key. This is the guideline. Okay, watch out for that. So basically, the accounting for the top two is the same. Fair value adjustment, unrealized gain loss, income statement. Okay. Let's do an example. That's my slide basically, my spreadsheet. Come back to that. Okay, so here's an example. Portfolio, we buy a bunch of shares, 3 companies, total 718. Each one less than 20. Any influence mentioned? No. So we assume less than 20 is, it's called the cost method actually. Okay, 718, let's book it. We buy the shares, 718. There's the cash, 718. And, one paid dividends. Who did? Republic. Paid dividend. Good, we'll take it. There's the cash, there's the revenue. Book that. Year end comes along. There's our book value, 718. As a group, they're now worth 683. So we're down by 35 as a group. Same entry again. We do a fair value adjustment. There it is. It's an unrealized loss, income statement, 35. And a fair value adjustment credit of 35, which offsets this on the balance sheet to give carrying value 683. Okay? And guess what's going to happen? I guess sell one. So this is a typical question. You make the first entry, next year comes along, and they sell Northwest for 287. They sell Northwest for 287. What was the cost? 259. So 287, 259, we gain by 27. We book it. There's the cash, 287. We clear the investment, 259. Realized gain, 27,520. Okay? So that one's gone. Northwest is gone. We book the entry, that's done. And guess what? It's year end again. It's year end again, and, beg your pardon, not yet. We sold one and bought one. We bought trucking shares for $12.75 a share. Total cost $256. Fine. It's in the portfolio. So we would debit investment $256 and credit cash $256. At year end comes along. There's our new portfolio. They're still there. Total $715. It's now worth $779. So we're up by 64. That's not the entry you make. We're up by 64. What's there from last year? A negative 35. Is that true? Yeah, negative 35. We want to be up by 64 at the end of the day. So we do an entry of 99, a debit of 99 to get to 64 based on this from last year. This is the key part of the exercise. Okay? That is not the entry we make. We adjust the balance sheet account to this. Debit 99. There it is. Debit 99. Unrealized gain 99 in the year. Is that right? Unrealized gain. Yeah, we had 35 loss last year. Now it's 64. We have gained by 99.
So pretty much the entry is just applied to force it to match your ending unrealized gain.
Right. You have an opening balance from prior year. This is the required balance at year end. That's the plug to get it to there. And this is the typical question. Typical question. Same as you have a portfolio, you book it. We sell one, fine, book it. We buy one, fine, stick it in. And then we have a new year end and a new adjustment. That's kind of the typical place. And so there's the entry, 99. Fair value adjustments, the contra asset, 99. Income statement, 99. Well, you sure, do you understand what I'm saying by contra asset?
Mm-hmm.
You know what I'm saying? It's next to the asset on the balance sheet. Whether it increases it or decreases it, it's next to the asset, like depreciation. It's next to the asset. This obviously increases it to this. And there's the unrealized gain. Income statement. Okay. So are you clear on these 5? Does it make sense? Okay, we're just adjusting portfolios based on this rule. Income statement, equity, both income statement. Okay. The last one's very different. Very different. But you guys get these 5? Well, really, that's 1. Here's no entry. It's just this, this, and this. Right? Only 3 entries. There's 1 entry here, which is the same as this. That's equity. And this. Okay. Any questions on? Okay. Okay, so I was going to do this thing. So if I said to you, let me see. If I had a stock for, if I bought a stock for 9, say in 17, in 16. So I was just want to explain something. Twenty 17, 2018. Sorry about the commas. Okay. Okay. So let's say I buy a stock for 9 in 2016. Okay? And the fair value year end, the fair value year end is 11. What's my entry in 16?
Right, how much is
It's a trading stock.
Doc? So if the fair value is 11, then the debit would be adjust.
Fair value
Okay.
adjustment.
Yeah, and then the credit unrealized holding gains or
So I would do
losses.
2. Unrealized gain
Mhm.
of 2. Okay? That's where we are in 16. Make sense? Okay. 70 comes along. Is it 80? And I sell the stock for 12. I sell it for 12. So what is my entry in 17?
So for 12, then the cash would be $12. Debit cash for $12.
That's somebody else.
Okay.
I'll go with it.
Sorry.
What's the entry? I sell it for 12. What's my entry?
Cash is 12,
I get cash. I do get cash.
and then debt, or not
I
debt,
get cash for 12.
The stock.
equity investment is 9.
Hang on. Equity investment is 9. Why?
So you bought it for 9?
Oh,
You
but you
sold
bought investment, yeah.
Yeah.
Investment is 9. I pay off the books.
And then you have a gain of 3.
And that's
That's realized.
realized gain. That's completely correct.
You have to reverse 2016's unrealized.
That's my point. That's my point. I have a realized gain of 3. That's true. The stock is off the books. But I'm still sitting with this on the balance sheet. So I must reverse it. Because this applies to a stock that doesn't exist anymore. So in 2017, I must reverse this. Okay, fair value, so we have unrealized gain, 2, and I clear the fair value adjustment of 2. Now we're done. We've sold the stock, reverse the unrealized gain. Okay? Okay. Here's the last question.
So do you reverse the unrealized typically when you actually sell
Yes.
the thing compared to waiting to the end of the period and doing them all as a portfolio?
No, you have to do it as you sell.
Okay.
They have software for this, don't worry.
Yeah.
A million shares. Okay. So what is my book gain loss in 17? How much better off am I in 17?
Just one
Or worse off?
gain of 1.
Gain of 1. Is that true? Yes, I've made $1 in 17. Because the book value at year end was 11. Right? It was 11 at year end. That's my book value. And I sold for 12. So my net gain in 17 is 1. But what's it made up of? But what's it made up of? That looks exciting, my favorite.
It's made up of you reversing your unrealized gain and then realizing your.
Yes, you're there. So it's a gain of 1, realized gain 3, unrealized loss of 2.
Yeah.
That's the entry, that's correct. There's my 1. It's this, less this. There's my 1 I made in 17.
And the purpose of this is just so you can spread out your gains and losses from investments while you're holding it.
Yeah,
basically.
you want your portfolio to be as accurate as possible every month. So you always book the unrealized gain loss. So you're always pretty close to market. So when you do sell, it's not a big change on your books. Because if we didn't make this entry of 2 in 16, we would have a 3 gain in 17. But really, 2 of that was in 16. The whole 3 wasn't in 17. We knew already in 16 it was 2 up. So when I booked the 2 in 16, I booked the 1 in 17. That's what this is. Okay, so always the fair value adjustment. The key point is though, when you sell a stock, it's always less the cost. That's the realized gain. Then you reverse the unrealized gains. Okay, all right, so throw that in. That's fine. Okay, so equity investment. I'm going to go off the slides now. This is the last part. Equity method. So I want to just, I'll do it by hand. So I think it might be easier if I do it on a spreadsheet. Okay. So let's say we have let's say I buy 40% of Apple, and it costs me $100,000. Okay. I buy 40% of Apple, and it costs me $100,000. I don't mention influence, so you can assume this is equity method, right? Which is the bottom one now. The bottom one. This is a tricky one. Right. So I buy 40%, 100,000, and then Apple has net income, say 500,000 in a year, and then Apple pays dividends total. Pays dividends of say 50,000. Maybe some odd number. Let's say 80. It pays dividends of 80. These are 3 key numbers. My investment, the percentage, net income of the company I bought the shares in, and the dividends they paid. Okay. First entry is obviously, we call the investment, 100,000, and I spend the cash. 100. Okay. Now, the equity method, it's called equity method because my investment will go up and down based on the equity section of the company I bought in. No fair values, nothing like that. So I'll say it again. My investment, 100,000, goes up and down based on Apple's equity section. If the equity goes up, my investment goes up. If the equity goes down, my investment goes down. Okay? Right. They made income of 500,000 in the year. What's my share of that? Apple is better off by $500,000 net income. What's my share of that? 40%. Yeah. So I book it. My investment is now worth 40% of 500. 200,000?
Yes.
Okay. And that is income to me. I made $200,000. Right? Apple made 500,000. Of that 500, 200 belongs to me. So I own Apple 40%. So I book it. There's my investment. There's my income, 200. Okay. Okay, let's stop right there. Okay, look at Apple's equity section. Net income 500,000, dividends 80,000. How much has that equity section gone up by in the year? I'll say it again. Wobbling. Income, net income 500,000. They pay dividends 80,000. How much has Apple's equity section gone up by in this year?
420.
420. Because dividends reduces retained earnings, which reduces equity. So Apple is really up by 420 in the year. That's right. Oops. Sorry. Should always have this planned out. 420. What's my share of 420? $168. So I'm better off by 168. Is that true? I'm better off by 168. Because Apple's better off by 420 total. 168. Okay, remember that number? 168. Okay.
That was the journal entry for dividends.
So Apple paid dividends. Apple paid dividends of 80. What's my share of that? 40%, which is 32. So I get the cash, they pay dividends. I get the cash, 32. What is the other side of the entry? What is the credit?
In,
Dividend? Dividend.
revenue?
This is the trick. This is the tricky one. What goes in here?
This is an investment.
Why is it investment? Why isn't it revenue? They're paying dividends.
You're accounting for the investment twice if you add it.
You're
You
right.
already took part of it back there at the.
Okay, let's say, if I put revenue here, right? This is the natural, we think, oh, I got cash. It's revenue. If I put revenue here, how much is my investment gone up by? Total.
You're 32 more than you should be.
Right.
Yeah.
I've only got this. But I'm better off by 168.
Mhm.
So this 32 is a credit to investment. And that's the tricky entry. This is credit investment. Now I've got my 168, 200 here, and a credit of 32. Okay. So this is the equity method, basically. You look at the income statement of the company you bought shares in. Look at what they did, income, dividends, up by 420. What's my share? 168. Your journal entry should show me up by 168, which is the debit here and the credit here. Okay? So paying dividends, when Apple pays dividends, it's good for my cash flow, but not good for my investment. Because it lowers my investment. Because the Apple equity section goes down. Okay? So this is the tricky one here. It's not revenue, you credit investment. Okay? That is the equity method. There's no fair values. We don't care about market prices, nothing. It's just what happened to the equity section of Apple, or the company I bought. So that is the equity method. Any questions on it? Okay. So like I said, back to my slide. You can see here, equity method. We assume influence. It's the change in the net assets or equity of the investee. There's no fair value adjustment, nothing. What happens to the equity section? I go up and down with them. Okay? Do you guys understand that?
Yeah.
Because that is the equity method. Okay? Very simply, I think the slides may confuse you, but this is what's going on. There's only 3 entries. The purchase, my share net income, my share dividends. And the dividends reduce my investment. That's the key one. Okay? So I'm better off by 168. 200, less 32. So if Apple paid no dividends, I'm better off by 2. But the fact that I pay dividends lowers the equity. It's not good for me. Okay? All right. Let's go back to the slideshow. If it makes any sense. Okay, influence. Again, yeah, it's I get the share of earnings and the dividends. Okay. So here's an example of, I can do this. Oops. Oh yeah, it does that. Yeah. What happened there? Look at wrong one. Sorry. No, I'm not sure why the next one is. Oh, it's only on my computer. So this compares both methods. So we buy investment 480. 480, that's the cost method, equity. So we buy 48,000 shares, $10 each, 480, 480, both sides. Mini records, income of 200. On this side, no entry. Equity method, yes. We will have an entry on this one. We will. We get 20% of 200, so that's 40,000. 40,000, income 40,000. On the other side, it's year end, we do a fair value adjustment. And it's now worth 576. So we do the fair value adjustment. 96, unrealized gain, 96. This side, nothing. No fair value entry. Right? They pay dividends. On this side, it's cash, revenue. Right? Equity side, it's cash, credit investment. This is the tricky one to remember, okay? Net loss of 50. On the cost side, no entry. This is the following year. On this side, we have a investment loss of 10, and we credit investment 10. It's gone down. That's a loss. We credit investment. And then here, fair value, year end, for those guys, yes. Us, no. So when they say cost method or fair value method, they need the top two. That is cost method. I'll go back to it. That's the key point. You know, you book the investment, do fair value, book the revenue, new fair value. Equity side, book the investment, share of income, fair value no, dividends, reduce investment, share of income, no fair value. Okay? So go back to my slide, if I can fix this. Hold on. So this, people say these two are the fair value method, or they say it's the cost method. Both kind of the same word. Okay? Cost, this is cost, this is equity. Okay? So again, like I said, this table is the key thing for this chapter. And it's all about the fair value adjustments. In a portfolio, year end, sell one, buy one, do the entry adjustment. Okay? That's it. Good. Thank you.
Oh, so will the final be comprehensive or?
Oh, beg your pardon.